Whitney Tilson, thanks for joining us. Appreciate it.
My pleasure.
Feels like I've been watching your career ever since I got out of college. Where does the time go, right?
You're dating both of us.
Fair enough. What are you up to? I know you closed your fund in September 2017. What have you been up to since?
I launched a new business called Case Learning. The old business called Case Capital, and I've pivoted from basically investing to teaching investing to the next generation of investors in a sentence.
What is some of your advice to next generation investors who are probably going out there, they're Google searching your name, they're like, oh, I want to be like Whitney Tilson. What do you tell them, especially given the fact many of them are graduating this season?
Yeah, well, first of all, go get some experience. I went to Harvard Business School, it was 5 years out of Harvard Business School when I decided to launch my own fund. In hindsight, I was sort of a late 90s bull market genius. There's an era that has some parallels to today. And one of the advice I tell young people is if you want to do this professionally, go work for somebody else for at least 5 years, if not 10. Learn the business, because it really is an apprenticeship business and it's an experience-based business. And I took a shortcut. Every stock I picked in the late 1990s was going up. That was the era, similar to today in many ways. The more risk I took, the better my returns were, again, similar to today. Sure. And I thought I was God's gift to investing, and so I went out and hung out my shingle as a hedge fund manager when I realized in hindsight, 20 years later, that I had no business running my own money, much less running money professionally. So what's interesting, though, is I got lucky and I got on a steep learning curve. I picked the right mentors. I started going out to the Berkshire Hathaway annual meeting 21 years ago. I've been every year since. So I learned fast, and I had a great first 12 years. But my lack of experience eventually caught up with me, both on the investing front, but also as an entrepreneur building a business. Made some mistakes, had real success, grew from $1 million to $200 million under management in the first 12 years. And then the last 7 years or so, made a bunch of mistakes. And I look back, and so one of the things I teach with Case Learning is both what are the things on the investing side and the entrepreneurial side that led to such tremendous success,
Do they think it's too easy?
Mistakes.
Does this graduating class think it's too easy? They see you, bull market, what, 9, 10 years?
Right.
I can do this.
Right. Yes, I think so. Investing is hard. Beating the market is hard. And it's very easy to learn the wrong lessons 9 years into a bull market. Back in 1999 when I started, we were 17 years into a bull market. So this bull market could continue. But everyone tends to learn a lot of wrong lessons during times like this.
What about the average investor? What can they learn from you?
Yeah. Well, look, I think keeping it simple. When I had my greatest period of success, I wasn't trading in any options, wasn't short selling. I just went out there and tried to make a few good investment decisions a year, buying high quality businesses when they fell out of favor. Something like McDonald's in 2001, 2002. One of the most iconic stocks in America fell by something like 75%, peak to trough. And I just bought a lot of it and held it for many years. Berkshire Hathaway itself, I've owned for more than 20 years, both personally and in my funds. So keeping it simple, I think, is one of the key lessons that really worked for me. And where I went awry is when I got too smart.
When I got out of school, one of the ways I originally came in contact with you through your work is Berkshire Hathaway.
Right.
What gives you confidence in life after Buffett for Berkshire?
You know, first of all, I don't think it's imminent. He's
not imminent.
It's not imminent, and that I think there's a very good chance he's running Berkshire at least 5 years from now.
Wow.
You know, he's in his he's 87. Charlie Munger's 94, but Buffett's the one who's really running the show. And mentally, he's never been better. Physically, of course, they're both slowing down. Old age tends to do that, but mentally, you know, the fact that he came very close to investing in Uber. Was just reported in the past week.
Does that surprise you? I mean, he's been averse to tech. I mean, we'll talk about the Apple stake in a second. But
yes.
Uber seemed kind of surprising.
You know, what's amazing about him and why he's been the most successful investor ever is he's got on a steep learning curve very early in life and has never gotten off that curve. And you don't see very many people in their 60s, much less in their 80s, still on a super steep learning curve. So the fact that he's introduced tech into his toolkit, initially not very successfully with IBM, but much more successfully with Apple, looking at something like Uber, I think speaks to how creative and nimble and open-minded he still is at this age. Very, very rare, very impressive.
So when, you know, let's say Buffett steps away 5 years, Munger maybe before then, what does a Berkshire Hathaway look like? Does it get bigger, what do you think it looks like over
Yeah,
time?
I mean, right now, if you look at Berkshire Hathaway, there's really no Warren Buffett premium built into it. He has built it to continue and to endure after him. It's, roughly speaking, 75 or 80 separate businesses, all of which have their own CEOs running those businesses superbly. It's a very large portfolio of stocks and bonds, and he's got successors in place. He's identified the investment successors. The operating successor is probably Greg Abel, but no one knows, and that could change in the next 5 years. So I think Berkshire continues to be a compounding machine, but it won't be quite as extraordinary as when the world's greatest investor is running it.
What do you think his inclination is on with the cash pile? I mean, he's sitting on a ton of cash. He's made it seem as if he's just not finding good values, but what is he waiting for to pull the trigger?
I mean, he is putting a lot of money to work, but he has a high-class problem. The money's pouring in at a rate of about $1.5 billion a month is pouring into Omaha. So the cash is building up, and it's hard, he's acknowledged, it's hard to put to work during a complacent bull market. But I respect the discipline in not rushing and rushing to put it to work and overpaying for things. But he's still done some fairly substantial deals over the past few years. Precision Castparts was well over $30 billion in one transaction, and that was during the market was. He paid a pretty rich price for that, but it's a pretty great business.
What do you think he's saying about Apple? I mean, he continues to add to his Apple position. I mean, it doesn't seem he's betting on Apple to $1 trillion. He's almost betting on Apple to $2 trillion. Or how does he think about it?
Well, he clearly views it as a very long-term hold, and certainly it would then compound over $1 trillion in the not-too-distant future and double again, say, 5 to 7 years later is what he's betting on. And I don't think it's a bad bet. As a Berkshire shareholder, I'm happy he owns Apple. I do wish, and I've written publicly, that I wish he'd bought Google, $12 billion of Google, as opposed to buying $12 billion more of Apple in the last few months.
What is it about Google that got you?
I like Google. I think both Google and Apple are insanely great businesses, and I'd like him to see him diversify his tech bet a little bit rather than going all in on Apple. I mean, that position's approaching $50 billion now. It would be nice to add some Google, which is a business that I think is a little bit better business. The stock's a little bit cheaper, and so personally, I like Google a little bit better than Apple, but I wouldn't argue with him. I'd say own both.
Where do you fall on the Google monopoly talk that's been floating around the past month and a half?
Well, one of the reasons I like it as a stock is it is sort of a monopoly in many of its product areas. They have 90% of the search market in most of the world, but they have 7 products that have 1 billion monthly average users or more. Not all of them monopolistic, of course, but very strong positions in things like email and maps and YouTube. YouTube's an incredible franchise. So, you look at Google, and if you strip out all the money they're spending on sort of Google Ventures and all this R&D stuff like Waymo, the business is even more profitable than it appears, and it's not trading at, if you back out, make some adjustments for cash and all, it's trading at roughly a market multiple for a business that's growing. Last quarter grew its revenues 26% year over year. Profits are still exploding. Like, it's still a growth company despite its enormous size.
Sure. Speaking of cash, or lack thereof, Tesla, take us through it. You've had an interesting history with Tesla. Where do you stand on it right now?
Yeah. It's interesting. I have a nuanced view on it. It was my worst short ever back in 2013. I shorted it when I now know, according to books and other reports, when it was within a week or two of bankruptcy, and they were about to sell it to Google. Interestingly, the short wouldn't have worked anyway because they were going to sell at a premium.
Sure.
But I wish they had. I wish it had only doubled against me because it ended up going 5x against me or more, from 35 to 205 before I covered in early 2014. Ever since, until just last month, I've been pounding the table, all of my short-selling friends who are drawn into that short position. And I've been telling them, do not short this stock. It is a bad short. Elon Musk is sort of a creative genius. They're in very large global markets. You just don't want to be short that. And they seem to have unlimited access to capital. Just in the past month, since the last earnings report, I have rescinded my view that it's a bad short, and I no longer argue with my friends who are shorted. And the reason is just my gut instinct is I can look at the financials, but they've always been sort of bad. The company's always burned a lot of capital, balance sheet has been weakening and all. But after the last conference call, Musk's increasingly erratic behavior, I think, has shaken the confidence of the analysts at big firms like Fidelity that sort of make the recommendation to put more capital into this business. It's now a career risk, I think, for people like that to be recommending Tesla, which means they could have trouble accessing capital, and they're going to need to access a lot of capital at the rate they're burning it. And
it almost sounds like they're going to be shut out of the market?
It's more they could have to do more of something that looks like a distress financing that could really whack the stock. And then you start getting into something that starts to look like Valiant, which is a lot of debt, shaken confidence in the market, where the declining stock price becomes a self-fulfilling prophecy almost. You know, I admire Tesla. I love their cars, don't own one, but I've driven them, and everyone I know who owns one loves the cars, and I think it's great for America that Tesla's here manufacturing cars and forcing all the big automakers of the world to make this pivot to electric cars. I think that's good for humanity. On the other hand, I can read a balance sheet and I can read a cash flow statement, and this company's going to need to raise a lot of capital. And I think Musk's behavior and the worsening balance sheet could make that a challenge, and that could be very bad for the stock.
Do you think somebody steps in here and buys him, or goes back to those Google days?
I doubt it, but this is not the kind of stock where if it does get cut in half or more, that you want to try and ride all the way down, because I think they do have a valuable brand and some technology and so forth that means that someone would come in and buy them. And so the same risk that I failed to identify back in 2013, which is I was shorting it, expecting them to file for bankruptcy, reading the financials. What I missed, though, is that there was someone who was going to come in and buy it. But keep in mind, that was much, much lower valuation. I was shorting at 35, and Google was going to buy it at around 70 or 72. So the stock is not only much higher today, but there are a lot more shares outstanding as well. So this is a much bigger company for another company to try and swallow. I think the stock would have to be down a lot before someone would come in and maybe buy it.
Well, I'm sure we'll find out soon.
Yes.
I got to get your thoughts on the overall market. We attended your short selling conference a couple of weeks ago. Really phenomenal insight. But why is now? What are you seeing in the market that would saying, hey, you know what? Let's start betting against this bull market.
Yeah, I'm not pounding the table saying we're here in bubble territory and I'm foreseeing an imminent market collapse. Interestingly, I wouldn't have closed my funds last fall if I had felt like things were about to get really ugly out there, because that's the perfect environment for a value guy like me. But this bull market sort of feels a bit long in the tooth. There's a lot of complacency out there. Valuations are probably at the 80th to 90th percentile, so we're not in bubble 99th percentile territory based on the numbers I see, and sort of looking, it's both a bottom-up and a top-down analysis that I'm doing. When I look at the 10 biggest companies in the S&P 500, I'm either long or would be long 5 of them anyway, so that doesn't smell like a bubble to me.
Is it a little worrying that there's so much cash concentrated in the FANG stocks?
Yes and no. It smells like 1999, but then I look at the numbers and it's not, which is back in 1999, companies like Intel and Microsoft were great companies. And if you look at their earnings have gone way up since then. But their stocks haven't done particularly well. Why? Because they were trading at 150 times earnings. Today something like Google is trading net of cash, you make a few adjustments and you're down in the high teens, 20 times earnings, which for a company that's still growing well north of 20% is pretty incredible. Sure. Even Facebook, which is trading a little north of 30 times earnings, they just reported 50% revenue growth and 64% earnings per share growth.
Doing okay.
And they're about a third the size of Google, so they're earlier on the growth curve. Like those it's hard for me as a value guy to say that those stocks might be cheap, but they might be. So the reason I put together the shorting conference, though, is in any kind of complacent bull market like this, you want to have some hedging in place, even if you don't think the market's going to tip over. And there are plenty of great short ideas out there. I'm just not willing to make a big market call that I think we're at a March 2000 or October 2007 kind of peak. I don't think we are.
Well, make that call when you're ready on the street.
Okay.
Whitney Tilson, don't be a stranger. Thanks for coming down. Appreciate it.
My pleasure.